So you have to surround yourself with subject matter experts. You have to spend a lot of time and research on it before you make your first investment. And then in terms of finding the investments, it's just networking, building up the connections that you have, going to conferences, all those things. And we talked about empathy before. I mean, at the end of the day, a lot of how you build your network is being a good partner. And if you're a good partner, then your partner says, oh, you should meet so-and-so. You've been good to me. I want you to meet that person. And so that's how you just continually spread out into spaces you may not be in currently.
If you or someone you know owns an apartment community, listen up. Storyboard Living is actively seeking 40 to 250 unit apartment communities within a 3-hour drive of St. Louis, whether that's Carbondale, Illinois, Columbia, Missouri, or St. Louis County. We're easy to work with and competitive on pricing. You can send information to deals@storyboardliving.com. That's deals@storyboardliving.com. Jason, thanks for taking the time this morning.
Thank you.
I really appreciate it. You're the real estate and impact lead for Lewis & Clark Holdings, which is the Hillman family office. Over the course of your impressive career, you've invested over or close to $1 billion in various real estate assets. So over 4,000 multifamily units, student housing, you've done industrial, medical office, so on and so forth. At Lewis & Clark, your real focus is programmatic partnerships with various groups, GPs, if you will, and also you guys buy some of your own deals as well. And then your current role also spans real estate, clean energy, affordable housing, and tax mitigation. That's a lot. And I'm excited for this conversation.
Sure.
I think you're going to provide a lot of value to anyone listening, watching, and I learn a ton every time we talk. Did I miss anything there with your current role?
No, well, I mean, with the family office, every day is a new adventure. So, I mean, really, you kind of just step up and do whatever's needed. No, I think you got it down pretty good.
So your role is clearly very unique. I'd love to hear kind of where you grew up, how you grew up, your first exposure into real estate or business, so that we can kind of get to where we are today,
Sure.
if that makes sense.
Yeah, that makes sense. So I grew up in Southeast Michigan, rural Michigan, and we've talked about it a bit. So right near the Canadian border. So for fun in high school, people would go across the bridge into Windsor at 19, because when you're 19, you can have a little more fun in Canada than you can in the United States. So I grew up with Canadian television and all of that. And but yeah, rural Michigan, mostly people that lived where I lived were farmers or they worked for the auto industry. And I actually grew up, used to be a farm, but then it was leased out because similar to the auto industry, farming was continually changing. So unless you had a lot of scale, you leased it out to other farmers. And so I grew up there and knew from an early age that I wanted to explore. And just there was nothing wrong where I grew up. It just was, there was more to life than that. So was able to go to college, was first in my family to go to college. Originally thought I was going to go into architecture. And then I talked to a lot of architects and they said, don't go into architecture. It's not what you think it is. So I luckily found urban planning and I really enjoyed it. Got to put both kind of that design part of my brain to work, but then also how do you collaborate with other people and how do you make neighborhoods and cities better? So I did that. I worked all throughout college. I worked for local governments. I worked actually in high school. I started working probably when I was 13 years old. Pretty much have worked through my whole life since then. Graduated from Michigan State University in 2000, was a planning consultant for developers and local governments for 5 years, all throughout Michigan and Ohio. And then kind of got that bug of real estate, not only just being a planner, kind of the evil planner who says, who's difficult about what projects get approved and slowing the process down, but kind of getting that bug of how can I actually be on that side of investment or on the side of development. So I went to University of Chicago, got my MBA and a master's in public policy. And same thing, worked while I was in school there, worked for the Department of Housing for the city of Chicago, worked for an investment firm that invested on behalf of a pension fund in multifamily, and loved it. And then I graduated and started working in really tailoring my work into affordable housing. So this was all in Chicago. We built over a dozen supportive living facilities all throughout the state of Illinois, plus just standard age-restricted affordable housing, multifamily housing for affordable, and then many other things, but all tied to affordable housing. And then about 11 years ago, got contacted by a headhunter. My wife and I had two young kids. My wife was originally from St. Louis, so the typical cliche of wife grows up in St. Louis, leaves, bring her husband back, and that's what happened with us. So this job came around for the Hillman family, and it was just a great opportunity to combine my affordable housing tax credit experience with real estate, and then also to be around my in-laws. And so we moved to St. Louis, and the rest is history.
So you've always been driven. You didn't have a ton of real estate exposure growing up, but you kind of created your own exposure through school and your early jobs and stuff like that.
That's right.
I would imagine you've always been pretty studious because at the age of 22, you ran public hearings for zoning. Is that correct?
Yeah, I mean, it was kind of trial by fire. I mean, as a planner, I mean, anybody that's been a developer and has been in public meetings have seen the best of times and the worst of times. I mean, people in planning commission meetings, ZBA meetings, sometimes it brings out the best, sometimes it brings out the worst. And yeah, I mean, I saw one example. Yes, like Pulte Homes was building a new subdivision in a town that I was a planner for, and this is a town that hadn't seen a lot of development. It was on the edge of the Detroit suburbs, and they were going to build thousands of units, and people were pretty up in arms about it. But it helped me to learn how to work with some pretty diverse groups, the developer, special interest groups about the environment, the citizens that live next door. And we were able to, over a long process, find a solution that really worked for everybody. So the development went forward, but in that process, they got walking trails, they preserved wetlands, they did all sorts of things that really benefited everybody. And so as a 22-year-old, that was really beneficial for me because it helped me think about the larger world, but it also helped me when I did my own development with some of our partners, going to those meetings, knowing what to do ahead of those meetings and working with the community.
Got it. I want to dig into your current role in terms of what exactly you do, and then also Lewis and Clark does in general.
Sure.
I think family offices are like this sort of mythical entity for a lot of people where where you don't really understand it. I know when we first met, I didn't really understand what you guys did or how you structured your partnerships and stuff like that. So I think that would be very helpful. And also I do want to say that I meet a lot of real estate people, of course, as do you. You stand out to me because you are very empathetic, and also it seems like you think very deeply about every investment you make and every move you make. Is that, and before we talk about Lewis and Clark, is that something that comes naturally to you, or did that kind of build up through your experiences?
I'd say it built up through all my experiences. Growing up where I grew up, I mentioned, agriculture was changing. I mean, the auto industry was changing. So generations had worked for Ford, Chrysler, GM, and then in a very short amount of time, those jobs started disappearing. And I worked in a factory between my senior year of high school and my freshman year of college. And I just remember seeing like people working in this factory and their whole career goals, and I'm not saying it's wrong, it was just their whole career goals was to get that job at Ford, GM. And that's great because people could have a really stable, successful life and work with that. But that world's that was changing. Same with farming and same with the auto industry. And those jobs disappeared. And it kind of imprinted in me like how that world changes and where people's perspectives come from. And I've just seen it over time. I mean, I grew up in the country. I went into city planning, and I've lived in many neighborhoods in Chicago. I live in the city of St. Louis now. Everybody has different backgrounds. Everybody's coming with different experiences. And we all need to find a way to understand that rather than say, well, you're different than me and I don't need to know who you are. And, I had challenges with my family growing up. Unfortunately, they're just not a large part of my life anymore because there's things you find out about people, unfortunately, and it just makes sense to protect the people you love the most from things like that. And that just imprinted in me a lot of different things. So yeah, I mean, I use that every day now. I mean, I think about, the challenges we have in the St. Louis region as an example. We've got the city of St. Louis, which has its own challenges for sure. And we've got, a lot of growth in St. Charles. And I wish we could have both where everybody would work together. We'd work together as a region. And I think about that from an empathetic standpoint. And it's not just St. Louis. It's the same thing in Illinois. I mean, everybody downstate has a lot of feelings about Chicago. It's just kind of how it is. And I wish it wasn't that way. And it's the same thing in politics now. I mean, when I was in college, I worked for a Republican senator, a state senator. And I have that background in my life, but I mean, to be honest, I probably vote mostly Democrat at this point, and that's because of my experiences. But it doesn't need to be like where it's this or this and they can't work together. And that's just unfortunate to me. And so I think about that empathy part. Like how can I help bridge some of those gaps? And so yes, I try to live that in my life.
So before we get to Lewis and Clark, you mentioned St. Louis. So let's talk about St. Louis. What are your thoughts on the region? How can we improve the region? And also, you being an outsider, you see things that locals maybe don't see. What are some of the strengths of the region as well?
The region has great universities. It has low cost of living. It has an airport, which everybody kind of brags on, but it still can get you where you need to be. Maybe there's a connection, but it still gets you where you need to be. You don't sit in traffic most of the time. It's like all these different things that are there. Beautiful architecture, amazing parks. We need to take advantage of those things. I was just thinking of an example, like, people talk about the brain drain that we have, where we have all these students come into St. Louis and then they leave as soon as they graduate. And people say, well, we need to find a way to get them to stay. Well, we need to find the part of the way we get them to stay is make sure that they have a great experience while they're here and work really hard with those students to encourage them to stay. And a lot of those students live in the city of St. Louis or in the inner ring suburbs. And so if they don't feel safe where they live or they have a bad experience, it's going to make it harder for them to stay. And so when I hear people in other areas in West County or wherever it might be say, well, the city's problems are their problems, it's not our problems. That's not true, because that is a great example of if you can get students to go to WashU from all over the world to stay and invent and create companies and do all those great things here, it has a major impact whether you live in Franklin County, if you live in Madison County. It has a huge impact on the region, not just the city of St. Louis. So those are all these kinds of things that we need to think about. So yeah, I mean, those are some benefits I see for sure in this region compared to other places. And again, we talked about it. I mean, I grew up in the country. I lived in Chicago. I've lived internationally and seen a lot of cities. And St. Louis is a really good balance between, in some cases, easy lifestyle living in the country and all the amenities of a big place like Chicago. We have professional sports. We have all these things that are here, and it's at a lower cost, and it's an easier way of living. And so we really need to take advantage of that.
Yeah, I would agree with you. And if anyone's listening or watching and has some good ideas, please share them with either of us. I think, both of us being from outside the region, we really have a real appreciation for the region.
Yeah, and I'm sorry to interrupt, but one thing I just thought of is, so I remember going to Venture Cafe in Cortex. Used to have a lot of events, and Travis Sheridan did this thing where he had a whole large audience, and he said, well, all right, I want to ask who is from the city of St. Louis and has never left. And so people would raise their hands. Who's from the city of St. Louis, left and came back? And then who's a transplant, who's never lived here, had no experience here? And then he asked the question, who's most optimistic for the city of St. Louis, or the region of St. Louis, I should say, and who's the most pessimistic? And it was pretty amazing to see the correlation for the people that were the most pessimistic were the people that were here in the region and never left, never had exposure to some of the challenges you have in going somewhere else. The people most optimistic were people that either left and came back, or people that had no connection to St. Louis, because they could see those benefits that you see, that I see coming here, all those things that I just walked through. With St. Louis, it's always 2 steps forward, 2 steps back, and it just puts people into a malaise. And we got to find a way to get people out of that malaise and be really optimistic and driven to improve not only their neighborhoods, but the region as a whole.
I 100% agree. And I've had similar experiences of meeting people that are not from here that really love it. And then meeting other people that are from here, and I'll tell them I'm from Toronto, and they'll make a joke like, why are you in St. Louis, or what are you doing here? Yeah. When I personally think this is a much better region to live in terms of quality of life and things like that. Let's talk about real estate and family offices. Sure. So if you don't mind, can you just give a background on Lewis and Clark, and then also what, generally speaking, family offices are and what they do? Yeah.
So Lewis and Clark Holdings, it oversees 3 platforms. So it's all managed by the Hillman family. So Tom Hillman is a serial entrepreneur. He's a great example of someone that's not from St. Louis, He's originally from the New York area, and he moved here to go to WashU and then stayed. While he was in college, he ran multiple businesses and just continued to have success originally in real estate, but also in operating businesses. And so through that success, he was able to build out the holding company, which we now have a venture capital platform, primarily focused in ag tech, but we do a number of investments in the VC space. We have our legacy operating business side. So we own a whole host of different operating businesses that we manage. And then we have my side. So that's the impact and real estate side. In terms of family offices, every family office is different. There are multifamily offices or single family offices. It seems like generally family offices will always kind of hold on to where their legacy was. They come from that background, so they still tie into that, but then they do try to diversify on through that family office model.
Got it. So you guys are investing in real estate, tax credits, and clean energy.
Mm-hmm. That's
Can
right.
you expand on the real estate piece? We'll get to at the end because I think we'll be talking about that a lot. But can you expand on what exactly the tax credits and the clean energy looks like?
Sure. So Tom has always been very optimistic or optimistic too, but opportunistic. And so even before I joined the firm, there came an opportunity to acquire large portfolios of state tax credits. These are mostly tied to affordable housing, sometimes historic preservation, but so you had an opportunity to buy large portfolios coming out of the GFC. So this is 2009, 10, 11. And so we bought them. And so the way that program works, I don't know if you know how affordable housing is financed, but
I do, but I think it'd be beneficial to kind of walk through it. And
sure.
And maybe we can chat about who might be a good fit for you guys if there's a potential to work with you on that side.
Yeah, so it's funny. I once was asked to teach a class at WashU on affordable housing finance, and it was like just one class. And I was like, I could teach, we could do a whole semester on this topic. It's so complicated. In 1986, the Tax Reform Act, they basically created an incentive for private business to help create affordable housing. And the way they did that was with certain tax incentives, largely the federal tax credit. And so developers typically apply to get those credits. There's two ways they can get it. They can do it through a competitive round, or they can do it through 4% tax credits and bonds. So I won't get into that. It's too complicated. But there's a few ways to get those credits. If they're successful in getting those credits, then they have to find a syndicator to basically monetize the credits. And they take the money from those credits, and sometimes they have HUD loans, or they have home loans, or different soft resources that are available, and grants. And then they use all that money to build affordable housing. So it's really complicated, and there's a lot of compliance that goes on for 15 years past that. So there's a lot of players. You've got your attorneys, you've got your syndicators, you've got lenders, you've got all these different groups, and the developers, of course. And so when I was in Chicago, that's what we were doing. We were helping to arrange financing, helping to develop and build and manage affordable housing. And then also I brokered some Section 8 assets, did different things in that space. Here, we had this opportunity to acquire state tax credits, which are a lot like federal tax credits, except they're generated by the state, but they're used against state tax liability. And so that is a situation where actually individuals can use those credits to offset their tax liability. Most of the time, federal tax credits are used by banks, particularly banks, because they have CRA need. And so that helps them to address it. So we bought this large portfolio of credits, and then over time, we've been selling those to high net worth individuals to help offset their tax liability.
So just to jump in real quick, let's say if you're buying them for 70 cents on the dollar, you're selling them for like 80 cents on the dollar, something like that. Does that make sense?
Yeah, it's you've almost got it.
Okay.
Yeah. You are buying them at a discount. The challenge is, in the case of state credits, it depends on the state, but it can be a 10-year credit. So you're buying 10 years of credits up front. So it's usually the discount rate lowers it a little more. Federal credits, same thing. It's a 15-year credit. You get you still have to discount it, but then there's also depreciation. There's other benefits. So sometimes you'll see credits sell for $1.15, and you're like, well, wait, how is it selling for $1.15 if the credit's worth $1? Well, the reason is because you're getting a lot of losses and you're getting other benefits, CRA needs, things like that. There's a whole market for groups that help sell those credits. What's amazing is when I was coming out of grad school, started working in affordable housing, it was 2008. So the world was falling apart. And the syndication market completely disappeared in like 6 months. It was gone because nobody had tax liability and everybody had complete uncertainty about what their liability was going to be. So nobody wanted to buy credits. So in that situation, the federal government had to step in and create different incentives to basically allow affordable housing to continue to get built. So anyways, so we've been syndicating those credits. We've largely sold our portfolio. We bought at a great time. We continue to put pricing out there to buy more, but we still have a private equity viewpoint. And so we have to get a return, a good risk adjusted return. And unfortunately, pricing on credits, unfortunately for a buyer of credits, but beneficial for the developers because that means they get more money. For a buyer, it just never made sense for us to buy more credits. So we largely got out of the affordable housing space. We'd love to do more if we could find the right deals to do. We did move into the clean energy space because it's another area that we could help the community. We thought that we continue to own assets. It's a space where there are good risk adjusted returns. You largely get the benefit of the investment in year 1 and 2. And then we own assets that we'll own for 20 plus years. It's a lot. It is a lot of work. I mean, part of my day to day is managing some of our solar portfolio, but I love it. It adds more to the diversity of what we're doing. And so it's really exciting.
So like clean energy, for example, or other avenues for you to invest in, how do you come across these types of opportunities? How do you educate yourself on them? I'm just curious because like you do a lot, and even as a firm and individually, and I'd love to learn how you are educating yourself or staying on top of what could be potential opportunities.
Yeah. It does take a lot of research because you don't want to jump into something like I'll hear from high net worth individuals that say, "Oh, I've got this great opportunity to buy credits." It's so complicated. You really have to do a lot of research to make sure you qualify for those credits in the first place. So you have to surround yourself with subject matter experts. You have to spend a lot of time in research on it, and before you make your first investment. And then in terms of finding the investments, it's just networking, building up the connections that you have, going to conferences, all those things. And, we talked about empathy before. I mean, at the end of the day, a lot of how you build your network is being a good partner. And if you're a good partner, then your partner says, "Oh, you should meet so-and-so. You've been good to me. I want you to meet that person." And so that's how you just continually spread out into spaces you may not be in currently.
Sure. Makes sense. And I think that might have happened with us as well. So full disclosure, we've been working together for a year, give or take. But we first were introduced maybe 4 or 5 years ago. And it took me a while to to get in. But since we've been working together, I think I've introduced you to a couple other people where I thought there could potentially be a fit. And I'm sure, if you have, tons of people like myself you're working with, that would quickly expand the network. And
Sure.
For what it's worth, you guys have delivered on everything you said you would, and being good partners. And I've really appreciated our relationship so far. And with that, I guess we'll talk about your multifamily investments. So
Sure.
On the apartment side, I really only know what you guys have done with us. What kind of apartment product do you typically target, or what kind of GPs are you looking to work with? And then how are you viewing your deals in terms of the types of returns you're looking to generate?
Over time, and we've really done just about all types of residential housing. We have not done single family housing. So that's one we haven't done. But in terms of affordable workforce, luxury, we've really invested in it all. And that's either through acquisitions or development. So we've seen it all. We've invested here in St. Louis. I wish St. Louis was easier to invest in. It's funny. I have a mentor who's based in St. Louis, but built his career across the country. And he said St. Louis, even going back 30, 40 years ago, was always the hardest market for them. There just was less margin for error because lack of population growth. There's not always barriers to entry. We have a lot of land. So we do invest here in St. Louis. We would love to continue doing more, but we also invest across the country. So we're done a lot in Georgia and California, and I mean, really all over the country. In terms of what we look for, it's whether it's multifamily or industrial or medical office, whatever it is. I mean, it's what are the fundamentals? What's your basis? Well, who's your partner? Location? All those different things that go into it. Our preference is long-term holds. If you do find an asset that has a moat that's protected and good bones, why not own that asset long-term? We do development though, and we've partnered with groups where they're building an industrial facility and they sell it even before they place it in service because they have a tenant, and it's a great opportunity to sell. You get a high IRR. And that's great. It's good to have that diversification. But for things like multifamily, it is so hard to build multifamily. Everything that seems to get built now is luxury, and there's a market for luxury. But for workforce housing, middle class housing, it's really hard to build that. So owning those assets and owning them long term, as long as you maintain them and are a good manager, that's great. We love that. But we are always looking for diversification. And then to your question about returns, I mean, it always depends on, what's the risk, what's the long-term strategy, and deal really has to work for a 5-year hold. Even if we're planning to own for 10 years, 15 years, does it work for 3 years? Does it work for 5 years? Going in with unreasonable expectations and then hoping it works in the long run, that's not something we want to do.
Got it. Can we talk about 2 examples? So one example of a deal you guys did, I think that'll be helpful to learn how exactly you're viewing all those things you mentioned. And then an example of maybe a deal you didn't do and why.
So a deal we didn't do, well, we've passed on a lot of deals over the years. Things that we look for are sponsor track record in not only like their whole portfolio, but do they have experience in that specific asset type in those markets? Because we've seen sponsors that have a lot of success doing one thing and maybe in one market, and then they say they're going to expand to 5 markets. And they don't know those markets, submarkets. They don't know, there's many ways that they could stub their toe as part of the process. So that would be a situation where we may pass. But we may keep in touch with them and see how that expansion goes. And then maybe we come in later. So the first question was,
it was like, if we can walk through a deal you've done, just to kind of dive deeper into why you would do a deal, and then also some of what makes a good deal in your eyes.
We can be very active. We own assets ourselves. We can be co-GPs or we can be passive LPs. It's really depending on what our partners need. We have, as an example, a partner in a skilled nursing facility here actually in the St. Louis region, out in St. Charles County. They're subject matter experts in operating skilled nursing. I'm not that. I mean, sure, they have a background in senior housing, but the day-to-day of operating skilled nursing is not my forte. It requires special individuals that can do that. So when we were approached with that deal, I just remember looking at their track record, looking at the site, looking at the fundamentals of the growth of St. Charles. And for, having all this experience in senior housing, the one space I never wanted to invest in was skilled nursing, because most people in skilled nursing don't want to be in skilled nursing. I don't know if you have any experience with it, but
I don't.
Traditional skilled nursing is 300 bed plus hospital-like settings, long hallways, terrible smells, just bad experiences. People being forced to get up at 6 a.m. to eat, no freedoms, like all those things you don't want, especially as you're approaching the end of your life. And it's terrible for the kids. It's just bad. So I've never invested in that type of skilled nursing. So who is now our partner now, the Al and Matt Beamer and the Beamer family, they approached us and said, well, we know you have this apprehension against legacy skilled nursing. What we're doing is something different. We're trying to upend the model. There's a few groups that are doing similar, where it's almost like villas product. We call it cottages. They got their background from greenhouse, which is basically you upend the model by designing the buildings differently. It looks much more like a house. You design the care structure differently, so that instead of a hospital structure where one day a nurse is taking care of floor 2 and then the next day she's floor 5, here the care staff is generally taking care of the same residents every day of the week that they're there. So they get to know the residents and they can provide that compassion and that care. And they may start seeing things that, because they're exposed to that person every day, they're seeing where, usually Joanna gets up at 9, she's getting up at 11. Or usually she eats a lot and now she's not eating anything. something's wrong. And so they can escalate it and see what's going on there and try to address problems before they really start to happen. It leads to better healthcare outcomes. It leads to much happier residents. We call them elders, much happier elders. And it leads to happier care staff because they're caring for the same people. They build relationships with the people that they're working with. There's a lot more certainty in the work that they're doing. And there's less, some of the things like bed sores and disease spread and different things that happen in skilled nursing facilities because of this design happens less. So all this stuff was things that we were researching back in 2016, 2017, which kind of goes back to your question of how do you go into a new space when you've never done it before? So that's what we did here. So we invested. Well, then COVID happens and COVID decimates traditional skilled nursing facilities for all those reasons I just mentioned. Labor gets much more challenging. The spread of COVID happened in awful rates in traditional, in not all, of course, but in some traditional skilled nursing. Whereas at cottages, it proved the model out. Everything we had wanted when we went into it was proved out. We had very little COVID spread. Labor generally stayed around. All those things that we had hoped was proven out. Of course, we didn't want COVID to happen, but it was great to see that all that research that the Beamers put into it and that we put into it before we invested was proven out. And so we were very happy about that. And so, I mean, that's a project where we'll continue to be a long-term investor in it. We're actually looking to expand it just because there's so much demand there for that kind of product. And it makes us happy. It's been a good financial return, but it just makes us happy that we're serving the community, providing a better option that they can get at a lot of different places and having those other benefits that are there.
So I'm guessing reputation is one of your factors you take into consideration when you're doing a deal. And I don't mean just the reputation of the sponsor. I mean your reputation as well as a company.
Yeah, absolutely. I mean, we've had plenty of sponsors come to us that, have a reputation and we have to be very careful about that. There's always room for giving people second chances. But if you know the reputation is legitimate and that person's not changed, well, we'll stop the conversation there. It's just, life's too short. We don't want to get in a situation where we've got bad partners and it's not good for anybody at the end of the day. And so there's plenty of good projects and good sponsors that are out there that we can focus on.
Sure. Makes sense. In terms of financial metrics, are you guys, when you're looking at a deal, and I'm sure it varies based on, the type of asset you're looking at, but generally speaking, are there some key financial metrics you're really looking at or looking to hit? Like, is it an IRR? Is it some sort of cash flow or yield on cost? Like, what are you looking at?
Yeah, I mean, we look at everything. We look at IRR, we look at MOIC, we look at cash on cash. We look at how quickly that cash on cash gets generated, all those things that go into it. Every deal is different. Again, if we do development and we go into it assuming it's going to be a shorter term hold, well, the IRR's got to be great because we know the MOIC it's still got to be decent enough for us to invest, but it's not going to, if you're going to have a quick turnaround, you're going to have an IRR, not a high MOIC, and you're not going to have a lot of cash flow year to year. So we look at it all. It just really depends on the particular deal and the long-term strategy for it.
So there's no real formula of, hey, if we're doing an apartment deal, we need to hit a 2x multiple and it needs to be a 10-year hold or a 5-year hold. Like it varies case by case. Is that right? It's
case by case, but generally, yeah, if we're buying multifamily, as we've done with you, I mean, it's what's the value add? Does it work as a 5-year? Does it work as a 10-year? How quickly is that value add? What kind of work is needed for it? Is it just jacking up the rents? Well, okay, I mean, that's one strategy. We prefer not to do that if there's also additional things that you can do. So cosmetic upgrades in the units, better amenities, better response on maintenance, things like that. Maybe there's a heavy lift and you do a much more rehab. Well, that increases the risk. So you'd hope that the return would be higher. So in terms of a MOIC, I mean, yeah, generally, I mean, if we're looking, depending on if it's acquisition or new construction, we do have kind of general ranges for what MOICs and minimum IRRs that we're looking for, and for yields as well. I mean, we've been approached by potential partners to acquire like manufactured housing at 3 caps. Well, I'd love to do more manufactured housing. I'd love to create more manufactured housing because that is a space in this world that is needed. We need more affordable workforce housing, and we need more housing that doesn't require tax credits to get built because there's a limited amount of resources that are available for that. But just to buy a manufactured housing community at a 3 cap and not do any expansion, it's really just to accumulate it, knowing that you've got an asset and you're not doing any value add, that's just not for us. The same way that buying something at a core asset where there's no value add at like a 4.5 cap or something, generally not going to be for us either. There has to be some compelling reason to invest. Now, there's a place as a seller, I hope that I can find those groups that are willing to buy at those prices. And their institutional capital certainly has been in that place where, if rates are low, that makes a lot of sense for them. So it just depends.
Got it. In terms of, you mentioned development and buying existing assets. How do you feel about development today? Do you think there's more risk with maybe tariffs and things like that? Or are you still doing development deals? And then also, are you seeing a lot of development deals that still pencil, that still make sense to get built?
Yeah, it's a great question. There was a lot more development happening when rates were low. It slowed down a lot. We invest in, as an example, in industrial in the small states in the Southeast. It was a lot of square footage that got delivered. That's tailored back quite a bit. We're still building. There's still ways to get things to pencil, but it's hard. It's harder. Similarly, in other asset types, retail's done very well. As an example, like grocery anchored shopping centers, things like that. They do very well, but they're also very hard to build. So it's very costly to build that. You have to have a lot of incentives. It makes sense, but it's just really hard to get them to pencil. So yeah, there is construction. There's still development that we're doing, but we're cautious about it. It's just there's a lot more risk. I'd say we were cautious when rates were low because of how much square footage was getting built. We were trying to do more acquisitions rather than development. And then now, to your point, tariffs adds a whole nother element. Unfortunately, construction costs have continued to go up even before tariffs. And now tariffs add some more uncertainty to that. We've been dealing with that for years. In clean energy, there's been a lot of tariffs with modules, getting modules from, a lot of modules were produced originally in China. And then because of the Uyghur labor and the terrible things that were happening there was a lot of pressure on the U.S. government to move that to other countries, hopefully the U.S. Unfortunately, that's slow, but it's happening. But yeah, we've been dealing with tariffs there for years and years. So it's a long answer to say, yes, we're still doing development, but it's really hard. And we have partners that we work with where we're like funds that we invest in, national institutionally backed funds. I go to their annual meeting and they say the same thing. They are very interested in many asset types, but it's hard to find deals that pencil in building standard multifamily unless you're just in a amazing market and you can get top of market rents. Student housing maybe is a little different. Student housing, you can still, if you're in the power conferences and you've got, walk to campus and you can get land at the right basis, those still pencil and people are still building a lot of student housing. But a lot of the other asset types, it's just really hard because of the high cost.
Do you have an asset type that you like for the next 10, 20 years? Like if you had to pick one, I know you're involved in multiple things, but if you had to pick one, what would you pick and why?
I don't know if you watch the Walker and Dunlop Wednesday webcast that they do. If you don't, it's worth watching.
Okay.
But Peter Linneman is on there and they ask the same question. Like, what would you, if you wanted to get rich, what would you do? If you wanted to preserve your wealth, what would you do? I'm not going to steal his answer, but I'd suggest watching that.
Okay.
Because one of his answers was data centers. And so that's, the asset du jour right now. I think, long term, certainly we've had success with acquiring multifamily, good Class B multifamily in good markets, similar with like shallow bay industrial, assets that are really hard to replicate, really hard to build right now that are in good markets. And if they're good vintage and have been taken care of, or you can get them to a place where they're in a good position. Yeah, those are things that we'd like to own long term. And then, we own solar assets, the same thing. You talk about some of the uncertainties. The clean energy space right now is facing a lot of uncertainties because of what's going on at the federal level and potentially some revocation, I guess, of the tax incentives that are there. We're watching it carefully, but I think it's still going to survive because we don't have enough power in this country. I mentioned data centers. As a country, our power usage had gotten to a point where it was pretty flat, and now it's through the roof. And it's because there's so much power being used for data centers and, to a lesser extent, like electric vehicle charging and things like that. And now it's through the roof. And we've got natural gas plants. We've got a whole variety of different things that we're doing. We're talking about doing nuclear again. At the end of the day, we just need to have every resource possible to provide the power that this country needs. And that should include wind, solar, all those different resources. So same thing there. Long term, we would love to own, if we can get good long-term PPA, so long-term contracts with the people that will buy the power from us for 20 plus years in good locations. Yeah, that's another asset we'd love to own. So there's a mix of different things that we would like. We're always trying to diversify as much as possible.
So I don't know much about solar, but do those trade similar to like apartments or industrial? Like, would those trade based on the contract and how much income those contracts are generating annually?
They can, yeah. It gets a little more complicated because, well, historically it was complicated because if you build it and it's financed with tax credits, there's tax credit recapture if you start trading assets within the compliance period. That's changed a bit. But yeah, generally, yes, that's the case. There are groups that will come out and buy existing operating assets that have good long-term contracts with credit off-takers. It's an interesting industry because you'll have groups that will be fully focused on developing assets to the point of ready to build, and then other groups will come in and buy it, and then they'll build it and own it long-term. So there's a mix of different things there. But yes, they don't really. Yes, it's similar to where you're looking at how much cash it can generate over time, and then you buy it on a multiple or a cap rate like that.
And are there like really large institutional players in that space that are buying?
There are.
Okay.
Yeah. There's all the groups that you can think of have a renewables group.
Do you think there's an asset type out there that doesn't have institutional capital flowing to it yet? Like over the last couple of decades, we've seen self-storage, mobile home parks benefit from cap rate compression from, the bigger groups starting to chase them. Yeah. Is there something still out there?
It's $1 million question, right? How do you get that before the institutions do and then sell it to the institutions? Yeah. That's a great question. But you're right. You named all the ones that, student housing is an example. It was all owned by mom and pops, all local groups that owned it. And then institutions found out about it and it's a whole different world now. Same thing with manufactured housing. Same thing with a lot of groups or asset types. I don't know. Let's talk about it because we're in the same boat. It's like, sure. How do we be opportunistic and find those assets that, because we don't want to compete with institutional capital. It's too hard at the end of the day. They have lower return expectations and they're going to outbid you, and they have bigger scale, so they can do it. But if you can do it before they get to it, yes, that makes a lot of sense.
I've heard, I have one answer that I won't mention because it's something that we can talk about offline, and we have talked about. But one that I've heard mentioned is parking garages. I've heard, and I don't know much about the space, but I've heard that that's a potential space where if you can consolidate enough assets, you can potentially get institutional interest at some point.
Yeah. I had some groups approach us in 2019 to start buying parking garages, and then COVID happened and, work from home, and like, hopefully that world's doing well. I have not followed up with it. I'm sure it changed a lot, but it also probably now presents a lot of opportunities as people start returning back to the office. And I'm still bullish on urban areas and central business districts, and those parking garages that serve those districts long term. I think we'll be fine, but there has been a lot of uncertainty the last few years. But that again presents opportunities. But we saw in Chicago. When Chicago privatized its parking meters, that brought in institutional capital, and they saw the opportunity there. You buy something there and you have an opportunity to increase parking rates and all those things, and you can make a lot of money. And they did very well, as my understanding.
Interesting. The thing that I love about St. Louis is there's so much free parking that people here don't like to pay for parking. Yes. But I totally see it.
No, that's where Look, I come from an urban planning background, and in Chicago, I took the trains everywhere. I lived in Copenhagen, I lived in Stockholm for a while. I took trains wherever I could, or the buses. And St. Louis, it's good that we have infrastructure here for mass transit, and we need to keep it. But we also have, it's easy to drive. We have free parking a lot of the time. So some of the challenges you see in other markets like Chicago, we don't have that here. So it's tough and we're spread out. So it's tough to assume that we're going to be able to rely on mass transit when we have all those other benefits like free parking.
The transit situation in St. Louis or in the region is really interesting to me because we have, like you said, the assets. We have Metrolink with, in my opinion, not enough riders on there. There's not enough traffic. I don't know what the numbers are. I haven't looked into it, but just anecdotally, whenever I'm on the Metrolink, I'm thinking to myself, if this was any other city, there'd be a lot more people using this. And then we have the extension to Mid-America Airport, not too far from here. And my thought process whenever I see things like that is, I hope and I think there will be some more development following this, because otherwise, how can the investment make sense? But we definitely have a lot of assets here that are underutilized.
Yeah. Going back to the empathy and trying to think about things from different perspectives. I mean, so have been just, and I'm, again, similarly, I'm not an expert on it, but you look at the north-south line of Metrolink, the expansion that they were talking about. It'd be easy for me or for someone that doesn't ride Metrolink every day, that has access to a car, or someone down in the suburbs to say, well, that doesn't make any sense at all. Why is anybody even having this conversation? It's so expensive. But if you think about it, I mean, those are neighborhoods and there are assets along those lines that, it may be difficult for people that live in those neighborhoods to get around. Maybe they don't have a car. Maybe they can't drive. And so that is why people are having those conversations. How do we connect to those neighborhoods, put them in the larger grid, transportation grid? That's where it's really tough. At the end of the day, yes, we are a driving city, but there are still people that take the bus. There are still people that take the train. And it really hurts me when I drive out in the suburbs and I see where the bus stops are. And it's like a bus stop on Lindbergh where it's like traffic driving by at 60 miles an hour and there's no cover, there's no, sidewalk to get to it. That's unfortunate because there are people that need to take that transportation. And in some cases, they're taking 3 buses to get to where they work. It'd be great if we could make it easier for people in their lives, whether with buses or whatever it is. So, yeah, I don't know. Again, it's not something they can solve today, but I just hope people think about those things as they go about their day to day.
Yeah, that's a great point. Just bringing Toronto back up, the greater Toronto area doesn't do a whole lot of stuff better than the greater St. Louis region, but public transportation is one of them. There's so many bus routes. It's very easy to navigate, just on public transportation. And all of the bus stops there that, I can think of have great shelters, for you to sit under, stand under, whatever the case is.
Yeah.
And I've never actually noticed it, but when you mentioned Lindbergh, I was thinking of Chesterfield Airport Road. There's a bus stop there with no shelter. It's like, right, there's nowhere to sit. Yeah. And it makes it very just unpleasant if you're someone who's utilizing those services.
Right.
Do you think density solves that for us? If we have more density as a region, if the city starts to see, more folks moving into the pockets that are a little more desolate today?
Well, population growth and density certainly solves a lot of problems. Now, again, and my wife goes crazy because I always try to be a devil's advocate. Again, that also has some negative pieces when you have gentrification, you have things like that. If it happens in a way that burdens people, and it can, then you can have some problems from it. But to your question, yeah, density, really important. Density would absolutely solve transit. There'd be more riders. If it was easy for people to get from point A to point B, and there's more people doing that, absolutely density would help. Yeah, I mean, you look at Metrolink, and yeah, there are times a day where there's not a lot of riders on it. But if there's a Cardinals game, then there are a fair amount of people that do ride it. So it's having events, having reasons for people to go to downtown as an example, or go to other places where the Metrolink goes or the buses go. That increases ridership. Making sure that it's safe, people feel comfortable riding it. All those different things go into it. But yeah, to your question, I mean, I just wish there was more population growth, more density here. There's a place for having less density. I mean, where I grew up was as low density as you can get, and there's some benefits to that. But you need to have a mix, and we need to have density. And again, getting back to our earlier conversation, I mean, to have a thriving region, you cannot have a hole in the middle, which unfortunately downtown has a lot of benefits and is doing well in a lot of areas. Every time a company moves out, that's less people that maybe want to live downtown, less restaurants that can survive. It just makes things harder.
If you have a blank check, aside from public transportation, what are you doing to benefit the St. Louis region, to drive population growth, maybe, fix some of the issues that we're seeing downtown? What would you do?
Well, again, I'm not an expert, but I mean, I wish we'd have less polarization and less divisiveness amongst the region. I wish there was greater cohesion of working together. I don't know what that solution is. I'm not saying better together was the solution, but there has to be a better way of doing it. St. Louis County having as many municipalities, it has 400-person municipalities. I mean, if you look into the history of why those communities were created, it's pretty damning at the end of the day. And it's just inefficient. Having these tiny communities that have their own police force, it's just so inefficient. And then the same thing when we're competing on the global stage. I know certainly with Amazon, we had multiple competing entries into it. Why don't we have one, working together, competing to get it for the region rather than City of St. Louis doing it, St. Louis County doing it, St. Charles County doing it, Metro East, whatever it might be. There are the examples that people throw out all the time are like Indianapolis, Nashville. They've found a way to coalesce and work together between cities and counties. And we can do it. We just have to have the right incentives for people to want to do it. There has to be a compelling reason for people in West County to want to be coordinating with people in downtown St. Louis and vice versa. And the same thing with St. Charles. They have to have a compelling reason. I know St. Charles continually will bring up they want more control over the airport. Well, that's one asset the city still has. So, I mean, maybe that's a tool where if there's greater coordination on the airport, maybe that's a way for we all find a way to work better. We have a great Forest Park as a jewel, and we have a great zoo and history museum. Well, the zoo's fund, if I recall correctly, the zoo's funded by not only city residents, but the county as well. Well, there's a great example of where we've come together to say, okay, maybe this is located in the city, but it benefits the whole region and it benefits the whole state. So how can we do that beyond just the zoo or Great Rivers Greenway and all those different things where we do have that coordination now? We can do it. It's not impossible. We just have to find a way to make it where people are incentivized and they realize how bad things can get if we don't work together. Because unfortunately, I'm optimistic about things. But if we just continually are at each other's throats and not willing to work together, I don't know how this region succeeds in the long run. Maybe there's good pockets here and there, but how do we keep our Fortune 500 companies? How do we encourage new ones to move here? Because if they hear that the crime is as bad as it is for the city of St. Louis, they think about that for the whole region. Mm-hmm. Or, they fly into the airport and drive down 70 and they see some conditions there. They have immediate reactions to certain things. And that holds back all of us.
Yeah.
No matter where you live in the region.
I completely agree with you. It's sad, but anyone that I know that has visited St. Louis without a tour from a local thinks it's not a great city and also is not impressed at all. Yeah. Anyone that has visited with a tour from a local and gotten an inside look and maybe driven through parts of the suburbs, parts of the city, different neighborhoods, things like that, they have a totally different view.
Yeah.
And it's not sustainable for us to give a personal tour guide to everyone that comes to St. Louis. So we definitely need to, I think, as a region, put an emphasis on correcting, reversing, some of these things we have going on. The 70 one in particular is really interesting because I've even heard from brokers in town that when they have out-of-state buyers come in, they don't take 70, even if it's a shorter distance to wherever they're going. Instead, they'll go from the airport down to 64.
Yeah. St. Louis is a huge economic driver for the state of Missouri. And it's a similar situation where it's like this animosity that goes on. It's great that we have a governor that's from the region that grew up and understands. I mean, he has so far been amazing with the reaction to the tornadoes and FEMA and really supporting and being here. Similar with Senator Hawley, same thing. But in the past, we haven't seen that. We just see a lot of like, the state says we can control you, but you can't make your own decisions. And so now I bring it up just with the police control. And 70 is a good example. I mean, 70 is, you can feel pretty unsafe driving on 70. I mean, my wife's been hit on 70 before while she was driving. I mean, we've seen all sorts of crazy things over the years. Hopefully, with like a police takeover with more focus, hopefully things will improve in the same way that, like the little stuff that people complain about, particularly in the city, where no license plates or expired plates, people running red lights, which is very dangerous. Like those little things add up over time. And that also adds to the malaise. So you got to stay optimistic. And again, hopefully everybody understands how important it is. And we work together as a state, we work together as a region, we can do that. So I don't know, but yeah, that's a good point about that. I remember being on a flight and I heard somebody behind me say, "Oh, have you ever been to St. Louis?" And the person said no. And he goes, "Well, I live in Clayton, and I would suggest you just go to Clayton and never leave." And he lives here, and that's how he's selling the region. Yeah. I mean, that is just really short-sighted.
Yeah, agreed. Well, I want to be respectful of your time, Jason. We end each episode with what's called a hole-in-one. So your greatest piece of advice you can share with anyone listening or watching. Do you have a hole-in-one that you can share?
Yeah, I mean, I think probably the best one would be, I know Warren Buffett said it at one point, and I mentioned a mentor. So Louis Levy is here locally, and he said the same thing to me. And it's basically like, you cannot have a good deal if you have a bad partner or if you're working with a bad person. So you had asked a question before about reputation and all that. At the end of the day, a deal may be phenomenal, but you just have to be comfortable with the group that you're with. And you're committing to being there together for the long run. So you just got to be with the right people. And you got to have the right mindset and be in agreement with what you want to be, what your goal is in the long run. That's been important to me. And it's certainly worked out for Warren Buffett and for Lewis too. So
thank you for sharing that. I like that a lot. Where can people learn more about yourself or Lewis and Clark?
Yeah, we have, of course, a website, but I'm always available. Yeah, Lewis and Clark Holdings. I mean, we've got like our operating businesses, and people are always surprised. So we are involved with Taco Buddha, High Point restaurants, all these different things. And so it's always funny when they say, wait, you guys are involved in that too? And we are, because it's just there's a lot of opportunities out there. And Ben Hillman runs that group, and it's just, there's so much passion there for that. And so needless to say, you can check out our website, or, things we talked about St. Louis, or if there's opportunities in real estate or clean energy, or even if there's something I mentioned that I have some knowledge or background in, I'm always willing to take coffees or have calls. So yeah, I can hand out information after the call, or people can go to the website and get that information.
So the website or maybe LinkedIn might be the best links for us
either one.
Okay, sounds good. We'll put both the links in the description.
Perfect.
Thanks for your time.
Yeah, thank you. Appreciate it.